Hello, I'm Michael Hainsworth. After 4 decades of falling yields, diversification is back, baby. Investors went on cruise control as equities quietly took over their portfolios. Fixed income was left behind when yields turned negative. Now, after a historic reversal, it's time to rediscover the ballast that bonds provide in choppy economic waters. But how do we navigate an environment where inflation is stubborn, growth is slowing, and politics buffets our brains at every turn? This is Romas Bud.
Well, Michael, the one thing hopefully clients can remember from our time together today, this environment now has changed completely. So the way you look at a fixed income should also reflect that the world has changed. And to us, that means you have to be more tactical. You have to think about Canada, US. You have to think about the quality of your income and corporate, and think about the fact that if the bond market is now in a different environment, which is more of a sideways up and down environment versus a steady decline, you're gonna have to be tactical, more strategic about how you think about the bond market.
On this episode of On the Money, we'll relearn how fixed income fits into a balanced portfolio. But first, markets don't move in straight lines. They ebb and flow. For millennials who came of age during the dot-com bust, graduated into the financial crisis, or bought their first home as interest rates spiked after the pandemic, it can feel like every time you get your financial footing, the ground shifts again. But cycles aren't chaos, they're patterns. Economies expand as businesses grow and people spend. They slow when confidence fades, inflation bites, or borrowing gets too expensive. Those shifts create waves in the market. Knowing whether we're climbing towards the peak of optimism or sliding into a trough of pessimism doesn't mean you'll perfectly time the trades. No one does. But it does give you perspective. Look at the 2008 financial crisis. Investors who panicked and sold at the bottom locked in their losses. Those who stayed invested rode the longest bull market in history. Fast forward to 2020, stocks cratered when the world shut down, but within months, the markets rebounded to new highs as stimulus and technology demand drove the recovery. More recently, as central banks hiked interest rates to tame inflation, we saw growth stocks stumble while defensives gained ground. Each cycle tells a story, and those who pay attention know when to get in and when to ease off. We all know the phrase buy low, sell high, but there's another phrase: there are bulls, there are bears. But it's the pigs that get slaughtered. When a portfolio is riding high, the smart money trims the big gainers and sets aside the cash for when stocks get cheap again. I suppose we need to start kind of at the beginning here. We had the pandemic unleashing a massive financial expansion. And then what? How did we get to where we are now?
When you step back, we spent roughly 40 years, if you can believe it, in an environment of interest rates going down overall. Look, we all had, there were the cyclical, we had the cycles within the business cycle, but generally interest rates all the way from September of 1981 to 2020, yields were going down. Now we're in a different environment. Yields have moved up. We had, of course, the supply chain issues coming out of the pandemic, inflation rising, the central banks reacting. But we've got a lot of other things going on now, too, that tend to lean us towards the idea that we're not going back to that environment of zero interest rates anytime soon. And in fact, we're probably in a different environment than we were pre-pandemic.
So then let's draw a line from the Volcker era to the present. When we look back at, say, 1981, peak yields, 40-year bull market for equities that followed, what did we misunderstand about the bond market's role during that period, and what lessons from that era still apply?
Well, I don't know whether we can say things were misunderstood. It was definitely a tailwind for assets in general, anything that required debt and debt financing, and of course, the discount rate for your future cash flows and things like equities. It was a tailwind all the way along. And now we're probably more of a just not a headwind or a tailwind. It's more an environment where interest rates are more likely to be moving in a more sideways range, I would say.
This is a little bit different compared to the last time we had a black swan event. And the sense that I'm getting is that things aren't exactly the same as they were the last couple of times we had to deal with this.
I mean, if you get into a black swan event, the bond market may react very similarly as it did in those previous events, in my opinion. It's more, I'm talking about just the general background noise of what's going on in the bond market. It'll be more of a sideways range. But look, if we end up in a recession, a big equity drawdown, I still think bonds will react the same way, which will be prices up, yields down, a real good diversifier for most people's portfolios, in fact.
A lot of talk about recession, some talking about something substantially greater than a recession. Where do you sit on this?
We like to say we go to where the data takes us. Right now, we're definitely in a slowdown. The U.S. economy is in an interesting spot as well. The GDP numbers actually look okay, but the labor market, the jobs market has slowed. So there's a real divergence going on. And that's one of the things we do expect to close over the next 6 months or so. Either the job market's going to have to improve or the GDP in the U.S. is going to come down. We kind of lean more towards the GDP coming down. So we do think we're going to get a slowdown. I think it's too early to call that a recession yet. In Canada, similarly, we do have a slowdown, especially coming out of the tariff hits that we've had. But on the other hand, we are waiting for the new budget. We're probably going to have a big further fiscal expansion in Canada. So we're not too concerned about the downside into a serious recession. Slowdown, yes. Borderline recession, maybe. Look, some areas will probably be in recession. In Toronto condo market, for example, I would call that in a recession. But generally, the economy, I think, is holding up reasonably well. Just not gangbusters, that's for sure.
For years, bonds were the quiet corner of a portfolio, that dependable ballast no one paid much attention to. And then everything changed. Fiscal fire hoses, supply shocks, central banks playing catch-up flipped the script. Suddenly, duration wasn't your friend, and risk came roaring back. Now, advisors and investors are being reminded that fixed income isn't set and forget. Yield curves, credit spreads, central bank balance sheets, they all matter again. The question isn't whether rates fall or rise next quarter. It's how all these moving parts fit together in a market that finally feels alive again. So, from what I understand, you're not expecting a serious recession at this point. You're getting more concerned. You're keeping a closer eye on it. So does that mean that the overnight lending rate at the Bank of Canada and maybe over at the FOMC, those folks are going to stand pat? What's your outlook on interest rates?
That kind of feeds into a little bit of how we are positioning portfolios on the bond side. The Bank of Canada has cut rates dramatically, as I think most people would realize already over the last year. Mortgage rates have come down, bond yields have come down a lot. We would say they are pretty close to done for now, maybe another quarter point. Again, unless we end up in a serious recession, then I think all bets are off and you're going to see more dramatic cuts again. The U.S., however, has barely started cutting. If you remember, they cut a couple of times, I believe, in 2024. The bond market didn't like it. Bond yields actually backed up, and now they've started cutting again, and the market expects 2 more cuts by the end of the year in the U.S. We're kind of leaning the same way, and that's one of the reasons we do think there's a lot more room in the U.S. bond market than the Canadian bond market. The U.S. 10-year yields, for example, are basically a full 1% percentage point higher. And we expect that spread to narrow as the FOMC cuts and catches up essentially to where the Bank of Canada has cut rates already. But that will take some time. So the Bank of Canada, we think, is pretty well done for now. Again, unless something odd happens. But the FOMC has a lot of room, and that's actually feeds exactly into how we are positioning portfolios.
So if the markets are expecting maybe another 25 basis point cut over the next year in Canada, are we ahead of the cycle? You mentioned that the Americans haven't cut to the degree that we have. Did the BOC go too far too soon?
All these things are hard to tell at the time. You kind of have to look back and see, what the impacts were. But I'd say they seem to have got it about right, judging by things like real estate. Again, Toronto, the real estate market, definitely softer, but you go across the country and, the real estate markets are not too bad. And now we're going to get, like I mentioned before, probably a fairly significant fiscal push from Ottawa to deal with some of the issues on trade with the U.S. So I think the Bank of Canada has gone about as far as they can go right now, and wait to see what comes out on the fiscal side. So I wouldn't say they've gone too far. I think they're about right. You never know, but we'll find out, next 6-12 months.
So then what does the disconnect between the traditional lockstep nature of Canadian and U.S. interest rate moves mean for fixed income investors?
That's a really interesting point we're trying to take advantage of as active tactical managers, like feeding back to what we talked about earlier on about the secular trend where yields generally were going down for 40 years, if you can believe it. That was a great environment or an ideal environment for passive and index funds because they're fully invested, prices are going up, bond yields coming down, generally speaking. Not so bad, right? But since 2020, when yields jumped quite dramatically, the environment has now changed. So now we're in a different environment where you got to be tactical and strategic with your bonds, in our opinion. The indexes also have changed over time. They've become more risky. So for most investors, they probably don't even realize that, an index today is very different than an index, let's say, that your father or grandfather invested in. It's more risky. The duration has changed. The duration's gone up a lot in the Canadian bond market index. In other words, the amount of price change or return for any given change in interest rates has gone up significantly. The credit quality of the index has gone down. The BBB component doubled in the index. So, and of course, there's no US in the Canadian bond market index if you're buying a Canadian index fund. So, and we think that's really, we talked about the FOMC and how much room they have to cut rates. We as tactical managers, that's where we want to emphasize where we can get a full extra percent. There's some real advantages there. FOMC just starting their rate cutting cycle. So again, the tactical funds we manage, we think are in an ideal situation now to outperform the indexes where the risks have changed completely.
You mentioned an increase in BBB. We're a lot more concerned about the credit quality of companies these days, maybe not so much governments, but does the calculus on the investment thesis change depending on whether we're talking corporate bonds or government?
For most individuals, it's probably good to have a mix of an income component to their bonds and an overall total return tactical component. But we do think you should be active in both sides of that portfolio now because of, like you mentioned, on the corporate side, the credit issues, how that, the companies have changed. You really need expertise to break down where the valuations are and which companies are going to be money good, so to speak, and which ones might run into trouble in the next recession. And we have an entire very large corporate group that deals with that. The government side, of course, the government bonds, whether you're talking federal or provincial or federally guaranteed bonds, such as Canada Housing Trust bonds in Canada, those will likely outperform if we end up in a recession, because the valuations on corporates right now are quite high. The spreads are narrow. You're not getting paid a lot of extra money to take on corporate risk. Again, if we don't have a recession, you probably skate through there okay. But in a recession scenario, the government side, which is where we're focusing, or my area focuses on right now, being a tactical manager, I think will be the place to be. But for most investors, they still should have a mix of, an income component and a total return tactical component.
I want to throw a hot potato into your lap. You've mentioned the difference between Canadian rates, U.S. rates. There's been a lot of pressure on Jerome Powell in the States to start lowering the cost of borrowing there even more. But at the same time, there's been a huge shift in the nature of the Federal Open Market Committee and just that the Fed generally, the politicization of it is significant. Can you trust the numbers coming out of Washington anymore?
Well, good question. A couple of points that you're bringing up there. First of all, on the numbers themselves, of course, we've got a government shutdown at the current moment in the U.S., so we have almost no numbers, at least from the government side. We only have private sector numbers. So that does make it more difficult, no doubt, until we get the government in the U.S. reopened and giving us data. But on the politicization of the Fed, that is an important question. And it does concern us, of course, at the edges that if it becomes politicized, the U.S. bond market and investors in U.S. bonds may be a little bit more concerned about the inflation growth trade-off and whether they're letting inflation rise, too significantly to protect bondholders that are longer-term investors. So I think it's still early. We'll have to see how that shakes out over the next year. We still think the FOMC, as it is currently comprised, we do still think they are serious about their inflation mandates, but there is a risk. There's no doubt if we go down the path of politicization of the Fed, that's where we also as investors would reevaluate how much we want to be in the US at that point, because obviously inflation is one of the enemies of long-term bond investors, and we don't want to be stuck there if they're going to emphasize growth and let inflation run hot, for example.
Okay, so we've entered a world where policy paths have split, and that's creating both opportunity and risk. The Bank of Canada is easing while the Fed's still cautious. That gap between Ottawa and Washington, it's where active managers earn their stripes, but it isn't just a trader's game. For investors and advisors alike, it's about rethinking how fixed income fits into the mix. That old 60-40 model didn't die, it just got smarter. Duration, credit quality, liquidity, they're back in the spotlight. So as we move into the final act, the goal isn't to chase yield, it's to rebuild balance in a market where stability finally pays again. How should investors approach this particular environment? We're always told, start top down, re-examine what your actual risk profile is versus what you thought it was, but what's the next steps?
Yeah, I think for a lot of retail clients and investors, they really should think about risk and go back to that, Michael, and go back to kind of almost basics and understand what their risk profile really is. Because over time, it's pretty clear. Equities have had massive run in Canada and the US, for example, big sector runs as well. A good time for investors to reevaluate how much they have in fixed income. There's no doubt when we got into 2020 pandemic lows in yields, you really weren't getting much income from bonds at all. So there's a cohort of investors that moved to things like dividend paying stocks, for example. But now yields have gone up. They've jumped up quite significantly, and then they've kind of trailed down again in Canada. And, never mind the nuance of being able to get better yields in the US. But you are getting a decent income now from the bond market. So some of those investors who went to equities for that income may want to evaluate that risk profile and whether they should be back in bonds, for example. And also going back to 2022 for the first, 2 or 3 times literally in the last 100 years, where you didn't get that diversification effect of bonds helping your portfolio when bonds and stocks sold off. If you look at the last few little mini corrections in the stock market, bonds have actually behaved well. So bonds are finally getting back their income component. Well, they've gotten that, but finally getting back that negative correlation, which reduces your overall risk of your portfolio. I don't know how much technical detail you want to get into there, but basically bonds are supposed to be the buffer, the ballast of a portfolio. And last time through in 2020, like I say, 2-3 times over 100 years, you didn't get it, but you are getting it now. We are definitely seeing the last few times stocks sold off, corrected, bonds behaved well. So, we're quite confident that they're getting back that ballast that bonds provide when there's a risk-off environment in the financial markets.
It seems though like today's bond index isn't our grandfather's bond index. If it contains risk that we may or may not have signed up for, what's your advice to the investor who bought a set it and forget it security?
Well, of course, that depends a lot for each individual. It can be very different. It depends on things like taxes and how old they are and what they're trying to do with their portfolio. But, I would circle back to this idea of going back, evaluating with their professional advice, whether it's an accountant or whatever. But generally speaking, we do see the environment now as far as the fixed income portion goes, if you've got your mix right on bonds and stocks, is having that income and tactical total return portion, both should be actively managed now versus just an index passive type of attitude, because the secular backdrop has changed and the corporate quality has changed. So people just have to realize it's riskier out there. Corporates are riskier within the indexes. Riskier corporates make up a bigger proportion. The duration of the index is higher. So your risk, if yields go the wrong way, that you lose more money than maybe you expected. And of course, by going tactical, you can take advantage of things like a full 1% higher in U.S. bond yields. Now, I do want to add on there, Michael, just in case we don't get to it, is the way we do it, we are not putting currency risk in that U.S. component. We do it through derivatives. That is strictly trying to capture the yield difference and not anything to do with whether the Canadian dollar goes up or down. And I think that's important, actually, because a lot of people like to take that risk within their equity portfolio, not within their bond portfolio. That changes the risk profile completely of a bond portfolio, potentially.
If there was one thing from our time together, Romas, that you would want someone to walk away with, what would it be?
This is not the bond market that people were sitting in all the way from 81 to 2020. So the way you look at a fixed income should also reflect that the world has changed. And to us, that means you have to be more tactical. You have to think about Canada, US. You have to think about the quality of your income and corporate, and think about the fact that if the bond market is now in a different environment, which is more of a sideways up and down environment versus a steady decline, you're going to have to be tactical and more strategic about how you think about the bond market.
Romas, thank you so much for your time and your insight.
Thank you, Michael.
For 4 decades, bonds were the wallflowers of investing, ignored while equities danced. But as rates rose and volatility returned, fixed income has stepped right back into the spotlight. Bud reminds us that this isn't just about chasing yield or timing the next central bank move. It's about restoring balance. In a choppier, higher for longer world, bonds won't make you rich, but they'll keep you from getting poor. I'm Michael Hainsworth, and now you're on the money. Oh, hey, don't forget to like and subscribe, hit the bell, all that stuff to be notified. It actually really makes a difference. Greatly appreciate it.